Thank you very much, and good afternoon, everyone. I think I was asked to come just given the importance of the mining sector to this exchange and to the general Canadian economy. So my objective here is maybe to speak 10 minutes about myself, my firm, my fund, and our outlook for the natural resource space, both in 2017 and beyond. Very quickly introduce myself, Matt Zabloski, Managing Director of a company called Delbrook Capital. We run the Delbrook Resource Opportunities Fund, which is a multi-strategy investment vehicle focused on the metals and mining space. When we say metals and mining space, we mean anything from precious metals to base metals, energy metals, industrial metals, etc. Trying to be the best multi-strat hedge fund within that space in particular. We started the fund in 2013, basically on the back of what we thought was a sector that was unloved by the general population. That was sort of 7 years into a bear market. Fast forward a couple more years, and we had almost a decade of a bear market. We struggled through it, but I'm happy to say that our fund since 2013 as an annualized return just over 25%. We're very excited about the market. We're very excited about being based in Vancouver. See Vancouver as a huge competitive advantage for us on the hedge fund side, and just very excited about the opportunity out there. There's not a lot of hedge funds in the space anymore. In fact, I just was making some notes before I came up here. The last 3 years, there's been $40 billion of capital raised for investment in the natural resource space. And I'd hazard a guess that almost $39.9 billion of that has been in the private equity arena. Given the volatility of the space, we find that troubling and think that the sector, with the volatility profile that it has, is much more akin to a hedge fund trading style than it is for a long-term 10-year private equity style of investment. So there were two questions that were posted to us before we came here to talk. One was potentially commenting on what woke up the market in 2017 or 2016, after as we mentioned, almost a 10-year period of lack of capital in the space. I think what really got the market going was the realization that the capex cycle in decline for the last decade had gone on for too long. The market woke up to things like supply shortages. In particular, something that we should mention is supply shortages in some of the zinc and copper producers, and in general, just the complete lack of invested capital within the space within most institutional portfolios. The way we look at the space in general from an institutional standpoint is first and foremost to understand exactly what it is that the market's missing on demand and supply for commodities. We can use zinc, for example. Our fund was very early to invest in the zinc space with our general thesis being that years of underinvestment and some major mining projects coming offline was going to lead to supply shortage that the market had not anticipated. So for us, we think when posed with the question, what woke the market up, it was simply the fact that this had not been on institutional investors' screens probably for a good chunk of a decade. The interesting thing as well, if you look at the space from an institutional standpoint, metals and mining in general have a negative correlation to the broad-based S&P 500 over a 10-year period. So as we raise money institutionally, mostly Canada, the US, and offshore, we really like to preach to people that this is a sector that needs to be represented in an institutional portfolio because of its negative correlation to the broad market index. What does that do for a large institutional portfolio? It should reduce portfolio volatility, and it should enhance returns as the cycle recovers. Makes a lot of sense to us, and I think the market's finally coming around to that in 2016. So they also asked me to comment on, what I think the big trends would be for 2017. What I'll say to you is, as a fund manager, we run pretty much agnostic to commodities. We have views both long and short in general, but we try to be as flexible as we can. We're not gold bugs in any sense. I view gold, copper, zinc all in the same sort of realm of importance, which is demand versus supply. But looking into 2017, I think the big factors we should all be focused on, and I just made a few notes here. On the macro side, probably the stabilization of GDP globally. We seem to have a bottoming in places like China and India. I think the slow return of capital to the space, which should be good for some of the exchanges as we're finally able to raise some capital for some of these stranded companies. And in general, the broad institutional base, just looking at the space again and realizing there is some benefit to having some representation in the portfolio. I can tell you with almost with certainty that this sector is underrepresented in most long-only mutual funds globally. My prior background, prior to coming to Vancouver and starting Delbrook Capital, I was a large cap institutional portfolio manager managing about $2.5 billion out of Boston. I keep in contact with a lot of these individuals who I used to work with, and I can say with certainty that there's no representation in this space in their portfolios right now. Obviously, as capital flows back in, we'll see it come into the large caps and all the way down to the mid and small caps. But I can tell you, 10 years of a bear market, given the market cap compression in the space over the last 10 years, what we've witnessed in 2016 is simply not even the first inning. It is the warm-up before the game. People will put money into this space in an increasing amount, and in our mind, given the lack of capital that was invested in the space in the last 10 years, this will be a grind higher over the next 4 to 6 years in our mind. Obviously commodity dependent when you're investing capital, but in general we can say that CapEx budgets have declined so much that it's going to take a lot more capital to come into the space, and that typically will only happen in a rising commodity environment. We've seen some commodities move nicely 2016, zinc being one, copper being the other, gold sort of bouncing around. But we think there's more to come, and I think investors need to focus on the commodity demand supply before they start making decisions about individual securities. The other thing that obviously bears mentioning is just the geopolitical risk out there right now. Our view is simply that gold will probably be range-bound in 2017. The reason we say that is we have two effects. Obviously, geopolitically, what's going on south of the border with our friends in the United States, but also some big elections that are coming up, France, Germany, et cetera, and still trying to figure out the ramifications of the Brexit event that happened last year. So we think the geopolitical risk is there and greater than ever. That should be supportive of gold, but we think the market currently has an incorrect view on interest rate increases in the U.S. I just looked today before I came over here off the desk. The views on an interest rate increase in March of 2017 are still below 50%. We think that's too low. We think the Federal Reserve raises interest rates in a couple weeks, and I think that's probably going to put a cap on gold in the short term. Other big themes that we're focused on in 2017 would be in the M&A market, the mergers and acquisitions market. We saw a lot of activity there 2016. Our view is that only accelerates. The cash flow profiles, production profiles of majors across the board look like they will decline significantly sort of post 2019. For those of you who don't know, the typical time frame to get a mine into production from a resource through permitting and online is anywhere from 8 to 15 years at least. So we think a lot of the majors out there, precious metals and base metals, will look to acquire high quality assets that are in development. We saw a bit in 2016. We'd call for a lot more in 2017. On the M&A front, some reluctancy sometimes to see some of these M&A deals occur. So I'd say the focus in the M&A world in 2017 will be an increasing number of transactions, either voluntarily or forcefully, as management teams come to the realization that the consolidation is somewhat beneficial. How are we looking at the market 2017? What excites us? For us, the biggest play right now, I think the market has the copper market completely incorrect. Even though the market's come up a little bit, we see supply shortages from the BHP mines, from the Freeport-McMoRan mine in Indonesia as big events. We don't think the market's appropriately priced that in. So that's a place that we've been spending a lot of time. On the short side, we've been looking, increasingly at raising our exposure shorts in the bulk commodity space, things like met coal, things like iron ore, et cetera, where we just don't see the markets currently appropriately priced. We think prices have come up too far, too fast. All told, though, I tell you, our view on the space, which is also great for the exchange, is that this is more or less a trading sector, not so much a long-term investing sector. I think investors need to be nimble, and I think 2017 should potentially produce a bit more volatility than 2016, and that investors ought to be prepared for that, because as much as we all enjoy rising markets, they can turn on you just about as fast as they did from the bottom 2015 until the end of 2016. So that told, those are our views in general on the market for the commodity space. If there were any questions, I'm happy to answer them.